It's another week of volatility behind us, and much of it really just came from the mouth of Donald Trump. First, he talked up the market, and then he sent the markets lower, indicating that he was going to ramp up the attacks on Iran and saying that he could send them back to the Stone Age. Well, markets really don't know necessarily whether to buy the dip or whether to expect things to worsen from here on out, and that's exactly what we're going to get into once again today. That alongside the release of key inflation data out of the US and jobs data out of Canada. So first and foremost, as we always do, we're going to look at the main events according to the economic calendar, but we're going to get into Iran first and foremost before we get into these. So services PMI out of the US on Monday. That's the ISM number. Remember, the ISM number also gives you a breakdown in terms of, say, prices elements, employment elements. So it's pretty good for that. The expectation is we're going to see a pullback on that front. Durable goods orders coming in for Tuesday alongside the IV PMI from Canada, then the FOMC minutes on Wednesday, and then things really start to pick up on Thursday. We've got, crucially, the core PCE price index alongside the GDP final reading, personal income, personal spending. Much of that is for February, though. And then we've got the inflation rate out of China. We've got the job support out of Canada and the CPI numbers out of the US on Friday. But like I said, things are really being dictated by one man at the moment, and that's Donald Trump. He's trying to do his best to try and keep markets in order to be able to essentially get the outcome he wants from the conflict in Iran. Now, crucially, the outcome that he wants appears to be shifting by the day. With each day that passes, the ability to be able to wipe out their nuclear facilities essentially becomes unlikely. The ability to enact regime change seems unlikely. And so now the new targets appear to be much more achievable. And Donald Trump wants to not only tell people that he's achieved all of the targets he set out in the first place, which is not true, but also wants to shift the blame for any of the fallout, which is very clearly happening and going to happen because he's not able to find a deal with the Iranians. They have become emboldened by all of this, and essentially he's becoming quite evidently knowledgeable about the idea that he might not be able to get what he wants, and the Iranians are quite happy to hold on out. The longer that they hold out, the harder this is for the rest of the world, and the pressure comes on Donald Trump. But most notably, Donald Trump feels the pressure when we see elevated inflation expectations. That, of course, could harm the Republicans in the midterms. Of course, Donald Trump in his last term here, he's not necessarily going to be impacted because he's not on the register to be voted for, but nonetheless, it does impact the ability to hold the House, to hold the Senate in the second part of his term. So the midterms will be crucial, and his popularity has been nosediving in the wake of this war. So he wants to shift the blame. And Europe appears to be at the front of the queue when it comes to people to blame, not anyone else. He doesn't want to sort of take aim at the likes of, say, Russia in the past, where they've actually been giving information to Iran to target US positions and US military personnel. But instead, it appears to be his allies, once again, that are bearing the brunt of it. Nonetheless, his appearance on Wednesday night, coming into Thursday, depending on where you are in the world, didn't really focus so much on the NATO story, which was certainly being talked around that at that time, but instead really sort of ramped up rhetoric about how hard he's going to strike the Iranians and this, that, and the other. I mean, ultimately, this is all part of a ploy to try and get them to come to the table, but the Iranians don't necessarily seem to be taking the bait, really. I mean, look, maybe they are having some discussions. We don't necessarily know who's in charge, and we don't necessarily know, exactly whether we're going to see any agreements, because the requests on both sides seem to be very far away from what each other will agree to. So whilst Trump talked earlier in the week about the idea that we're going to see the US leave very soon and everyone else can deal with the fallout of the Straits of Hormuz, that seems unlikely, and I'll sort of bring that into play here. So you can see that whilst we have seen a gradual increase on the number of vessels passing through the Straits of Hormuz, and that does alleviate some of the concerns around oil prices. Notably, there is a perception that Iran's now set up a toll system where it's charging each ship depending on the size of the ship and who owns the ship, and also the payments are taken in Chinese yuan. So not only is Donald Trump coming into this conflict saying he wants to hamper Iran and set them back and replace the regime, well, the regime's still in charge and they've got new sources of revenues. They're going to charge every ship that passes through the Straits of Hormuz from here on in, and they're going to charge it not in the US dollar or petrodollar, but in the Chinese yuan. So this points towards why Donald Trump would want to leave with some sort of resolution that isn't just, oh, okay, everything's fine, I don't care, it's not my oil, which is certainly what he's been saying, but he has essentially helped the Iranians on this front. He may have blown a lot of stuff up, but the Iranians have new forms of revenues. They have the sanctions on their oil taken off and a higher value to that oil. So they're probably quite happy to carry on as things are at the moment. Part of why the US probably do have an ability to hold on longer than the rest of the world would like comes down to the fact that they are self-sufficient when it comes to energy. So yes, they are impacted by the price of oil, but to a lesser extent because, say, WTI is lower than Brent crude and lower than, say, Dubai crude. But when you look at nat gas prices, they're rock bottom. And they've barely budged in all of this. And that's US nat gas prices. If you look at, say, European gas prices, which is the TTF, Dutch gas, you can see we've seen a massive surge in terms of pricing. And that puts pressure on Europe. And so, you know, the fact of the matter is, in all this crisis, Donald Trump, alongside Netanyahu, well, Trump is happy to go in and cause all of this havoc, but it's everyone else bearing the brunt of it. So, yes, you know, he'll have everyone know that they're paying for all of this and that they're the ones that are out for this conflict. But they're not suffering to the same degree as Asia. They're not suffering to the same degree as Australia, as Europe. And that suffering might come down the line. But at the moment, I don't think it's necessarily there quite yet. And you can see that here. US natural gas prices just haven't really budged in all this. And that unfortunately provides the basis for him to be able to hold on for longer. And so really the pressure is on other things, to an extent oil prices, also to an extent equity markets. So here you can see there's big differentials between pricing according to where the oil is. You can see the cheapest of all is North America, WTI, once again, and then European oil with Brent. Then we've got the Russian as well, just below that, in actual fact. And then you've got Middle East Dubai crude, which in actual fact has pulled back. And there have been some concerns that that massive rally in Dubai pricing was the level that we're going to see a catch-up play, and that European pricing was going to come to it. In actual fact, that's pulled back some, but now starting to move higher after Donald Trump's comments. And another thing worth noting is the fact that people, yes, have been focused on the price of, say, Brent crude, but other products have been really key in all of this, and that provides the basis for expectation of higher inflation. Key amongst those would be diesel. We've seen a massive surge in terms of diesel prices, and the US isn't necessarily as protected when it comes to the price of diesel. And remember, diesel is generally the material or the product that goes into delivery trucks. So your Amazon delivery truck is probably diesel powered if it's not electric. Your lorry that's going to be shipping goods across the country, that's probably powered by diesel. So this is a key input price for businesses that's shipping around the world and logistics. So it does provide the basis for future inflation pressures to come. But nonetheless, we're not necessarily trading diesel right now. And so I wanted to take a look at Brent crude to kick things off. And you can see exactly the swings over the course of the week just gone, with the pullback off the back of some of Trump's comments that, you know, I'm going to be gone soon and everyone else can deal with Hormuz. I don't really care about it. Then all of a sudden he has his speech and we see that massive rally back. And if you look at, say, the 4-hour chart, you can see that by and large, I think I put out some commentary earlier in the week or at the back end of last week saying that oil didn't go anywhere. And I thought, you know, if you were living this, you certainly didn't feel like oil wasn't going anywhere. But my point was, this is where you started last week, and then this is where you ended it. So we were sort of back in the realms of where we started. But of course, within the week, you're seeing significant volatility coming into play. So it certainly feels like you're getting a lot of volatility, but it can be a bit crazy when you get to the end of the week and you're like, wow, we're pretty much back where we started. Well, crucially, where we started last week and where we ended last week is pretty much where we are heading in towards the weekend this time around as well. So, it's interesting that with Brent crude, this sort of 107 area up to 108, down to 106, that kind of area really has been a key sort of point of reference. Now, if we look at price action on the daily time frame, you can see that we do keep coming in towards this 110 mark, 112, but failing each time. Unfortunately, there is a possibility that what we're seeing at the moment is sort of a rising triangle formation, that we do see another big breakout to come, and possibly that comes after a incursion into Iran. Of course, there's been this buildup of military personnel. Perhaps it's a case of the US trying to put pressure on Iran to do a deal, or else we're going to come in and we're going to take Karg Island. You're not going to have any oil revenues. You're not going to be able to have your toll booth in the Straits of Hormuz, or we're going to take all of the uranium. A lot of speculation, but if we did see that and we saw US troops landing in Iran, it would be a sitting duck target for them to launch a bunch of rockets at. And if we suddenly see a huge amount of loss of life for US military personnel, well, then you've got the possibility that this really escalates from here. So that, to me, would likely push things up through that resistance mark. But ultimately, and I've run through this every single week, what happens in terms of oil at the moment really is sort of dictating sentiment across many of these markets. When you overlay them, they're all interconnected right now, because oil prices influence inflation expectations, influence expectations of what the Fed's going to do. That influences the US dollar, the likes of gold, the likes of equity markets. So everything's really feeding into the same thing right now. And I think oil energy prices are really at the forefront of that. But yeah, we're coming into resistance as we head in towards the weekend. There's, of course, growing fear around the possibility of another big spike if we see things escalate once again. So yeah, oil, energy markets, Iran, Trump, all of that really remains the big ticket item for traders to get a grasp of at the moment. Next up, we're going to take a look at the US. And like I've said, we've got at the back end of the week, the CPI release. I think that's going to be the most important of the lot. We have got Wednesday's FOMC minutes coming out, and we have got the core PCE price index on Thursday. But bear in mind that core PCE figure is a February reading, and therefore the CPI figure on Friday provides the main event of note. There's an expectation it's going to come in at 0.2 for the core. And we don't have the month on month here for the headline, but you can see by and large the cores expected to tick up on the year on year to 2.6%, with a sharp rise in terms of that year on year for the headline. That really points towards the idea that we're going to see a sharp rise in terms of let's just see, in terms of the headline CPI figure. I'm just going to try and see if I can find the expectation for that reading this time around. There we go. The expectation is that it's going to come in at 0.8 from 0.3 last time around. A massive spike in terms of inflation expected to show up in Friday's CPI release. And that could provide the basis for dollar strength, greater inflation concerns, so weakness in terms of gold, things like that. So this is really going to be the big ticket item for the week. You can see here we have got the divergence in terms of the two, the PCE figure up to 3.1, the CPI figure at 2.4, core PCE. Of course, core strips out energy components, so you wouldn't necessarily think it's going to show up to the same degree in that front. But that divergence pointed towards at some point either a catch-up play with CPI rallying or the core PCE figure rolling over. Well, it looks like it's the former. And if we do see that surge in terms of inflation pressures, then we're likely to see markets react in turn. You can see in terms of market expectations for this year, the calls for hikes are kind of going out the window. But right now, everyone just thinks we're not going to see anything this year whatsoever from the Federal Reserve. So I guess the question is, what's it going to take for us to think that we will see something, and what would that be? Well, More likely it would be a hike, and that comes if we see a really radical, dramatic spike in terms of, say, inflation, or in terms of energy prices, which would probably be the first thing, because of course that's live and happening to that moment. So let's just jump into the charts, and we can see here, this is the dollar index. You can see here that we've sort of pulled back into this retracement after that sort of good news story around this idea that the war was going to end soon. And now we're seeing that big bullish engulfing candlestick formation coming into play. This potential bottom here for the dollar index, and from a wider context, it highlights that it's playing into that wider narrative. So are we at a bottom here? Potentially, and certainly if we rally up through this resistance level around just sort of 100 mark, just above that 100.6, that kind of area points towards a potential breakout coming into 4. And in particular, if we see a really strong move higher in terms of inflation, well, then that provides the basis for people to start thinking we're going to see that kind of move. So 0.8 expected for CPI. That is a major concern, and in particular if things really ramp up over the course of the weekend in terms of an escalation, potentially boots on the ground, that all feeds into the same narrative as well. So I remain bullish for the dollar index until we break out from this trend. The most recent pullback came into the 76.4 absolutely perfectly. So we're rallying. We haven't broken up through that resistance level, but if we do, that is a warning sign that we could see a base having formed for the US dollar, and that things could start to turn a little bit ugly once again for gold, as we see here. Let's just put it on and invert it. There we go, invert the scale. As you can see here, we have got that relatively close correlation between the two. So a lot of the time, if you do see the US dollar gaining ground, then you're likely to see weakness in terms of, there you go, weakness in terms of gold. So yeah, this is a warning sign. We've got a week ahead that does have the potential for a surge in inflation in the US, and that could really provide dollar strength and weakness for gold as a result. And finally, let's just jump into the slides once again and look at things from a Canadian perspective. You can see we've got the composite PMI, the services PMI, the IV PMI. Then we've got the jobs report on Friday. Unemployment expected to rise to 6.9%. The employment change expected to come in positive at 30K from minus 84K last time around, and a sharp decline in terms of average hourly wages. But there's some key things to watch out for here. I mean, firstly, yeah, the rise in terms of unemployment comes off the back of a bit of a pullback, so it's maybe not as worrying as if it was a sharp continuation of that previous move. Crucially, we have seen a surge in terms of oil prices. We haven't necessarily seen that in terms of the Canadian dollar. So this does provide the basis for a potentially positive outlook for the CAD going forward. And you can see that particularly here with the Australian dollar against the Canadian dollar overlaid against copper versus WTI. We've seen a collapse in terms of the commodities, but not so the FX. And that points towards a possibility of a catch-up play coming into the fold. In terms of the Bank of Canada rate expectations, well, nothing quite yet, but markets are pointing towards a possibility at the back end of this year that we could see the Bank of Canada hike rates. And in which case, if we do see a strong jobs report, then it provides the basis for that stronger CAD, where people think that maybe the economy is strong enough to be able to hike rates after this period of easing. Let's jump onto the charts and end things up with that Aussie CAD chart. So if you look from a wider perspective, you see this big, strong rally that we've seen here, but you've got the possibility of it rolling over if we see that WTI copper relationship follow through. If we see a stronger pricing in terms of oil, could we see the Aussie losing ground and topping out here against the Canadian dollar? Undoubtedly, inflation is more of a problem in Australia. That's why we've got that hawkish outlook, and that's what has held this up for the time being. But if things start to change on either the Aussie front or on the Canadian front, then things could start to shift on this front. Notably, when you've got problems at the pump, shortages in Australia, then inflation is likely to be more of a problem in Australia, and that could hold things up. So keep an eye out for the Australian versus Canadian inflation picture as well. That's really going to inform you on this front alongside that ratio between WTI and copper. And that's why, for the most part, we haven't seen the follow through. If we do see inflation data where either holds and doesn't surge in Australia, or we start to see a surge in terms of Canadian inflation, then we could start to see this market roll over with a break below 0.95 being that bearish signal. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Have a good day, a good long weekend if you've got it, and have a great week ahead. Thanks a lot.